Yatharth Tyagi with us, whole-time director at Yatharth Hospital and Trauma Care Services. When I'm looking at the numbers, they look like a very decent set. Revenue up 36%, EBITDA up 30%, margins at 24.2 versus 25.4. You've got some serious bed additions coming in. Bed capacity was at 1,600 in Q4 FY25, over 2,500 now. Occupancy also inching up. It's all looking much better on a YOY basis. Mr. Tyagi, give us a sense. Therefore, what should one expect in terms of FY27 numbers? It's a very strong FY26 for you.
Thank you. Thanks for having me. Yes, it's been a strong financial year for us. The YOY 36% growth that you're seeing, has been coming from the addition of new hospitals that we have started. So this year we have made 3 hospitals operationalized. One was the new hospital in New Delhi in the area of Model Town. Second was Sector 20 Faridabad, as well as Q4 saw contribution a bit from the new facility at Agra. So these 3 hospitals combined together, around 1,000 beds we added, which contributed meaningfully to the top line. Contribution of, in fact, in Q4 of the Model Town and the Faridabad hospitals alone has been upwards of 12%. So as well as the existing hospitals that we have in our other cities have also grown. That has been primarily because of the increase in the ARPOB. Our Nod Extension, Greater Nod Hospital today are clocking ARPOB of upwards of 45,000. So this has been the result that which has led to high increase in the overall numbers. Going forward, as far as these hospitals still we feel are still not reached maturity stage, the 3 new hospitals. So FY27 will still see a significant ramp up of both the occupancy and ARPOB in these hospitals, and we feel the 36% YOY growth that we have shown this year, we should be surpassing it in the next financial year.
Surpass 36% growth in the next financial year. That's really the very strong guidance you're giving. What happens to occupancy? Before I actually take occupancy, let me ask you, how many beds do you add in the next year?
So today, we have around 2,600 beds. Yes. As far as the announced capacity is concerned, we have 3,500 beds. That includes the new Gurugram hospital that we just acquired, which is 250 beds, which will be operationalized within 12 months, as far as the brownfield expansion of 2 hospitals are concerned. So, with the increase in the announced capacity, we feel that next financial year, somewhere around 300 to 500 beds will also be operationalized. However, we are targeting as total to reach 5,000 bed capacity within next 3 years.
Beds to be added next year. What happens to occupancy and the 36% growth on top line? How much of that plays out with regard to margins? Because that's probably the only, I won't call it softish either. A slight bit of lower or contraction is with regard to where your numbers stand. Do margins also go higher despite the 20% bed addition that you do?
See, margins, is as per our guidance. In Q4, this was a guidance for the full financial year also. We were targeting margins of somewhere around 24 to 25% for fiscal 26, and that's where we are. And this is as per expected. It's purely because of the drag of the new hospitals, the 1,000 beds that we have added, which has led to this marginal dip in the margins. Going forward, we are sure that we would be somewhere again around 24 to 25% as the full financial year is concerned. In fact, I think the margins should sort of also improve, given the fact that the new Model Town as well as the Faridabad hospitals, might we were looking to break even from the starting of H2 of FY27. So I think there should be a marginal increase in the EBITDA margins, but overall, I think somewhere around 24 to 25 would be the guidance for the coming years forward. Occupancy is concerned, I think 71% is where we are this year. This will remain at a steady state. I think this should be the stable occupancy numbers we do expect. Because we are adding up new beds each year. So if you're able to maintain this number of occupancy, I think that's the guidance going forward as well.
What is the kind of current debt levels that you have? And as you increase your beds to, or maybe double your beds in the next 2 to 3 years, what is the kind of capex that you plan, including the 3,000 beds that will come in the next 2 to 3 years?
Debt today stands, somewhere around 240 crores. If we talk about net cash position, it is somewhere around 115 crores. Going forward, we expand further, we are well in the position to have a larger share of internal accruals that would be, the company would be driving in the years ahead. Still, there's some room for debt is concerned. So I think the capex for the expansion to 5,000 beds should easily be funded by the internal accruals and some room with the debt that we might still onboard going forward.
Is there a plan to come to the market and raise some equity as you expand your footprint in northern areas as well, northern India?
I think as far as 5,000 beds are concerned, there's no more requirement for external funding. I think these 5,000 beds are easily possible from the internal as well as the debt accruals. Also, going forward, one important aspect the company is focusing on is reducing our debtor days. Somewhere it has already been reduced to 112 from a larger amount years ahead. Going forward, we feel a significant reduction in the debtor days will also result in high internal accruals, and that's why we are quite confident the company should be able to fund the capex requirement from within itself.
It's mentioned, the ARPOB of around 45,000 that you're planning or you're targeting, right? From the new once the new additions come in, what would be the average once all the new 3 hospitals become break-even? At that point in time, how is the ARPOB looking? Because currently at the end of Q4, it's around 33,000.
So ARPOB, if I talk about in the new hospitals, is much higher than the group average. The New Delhi hospital, has started with an ARPOB upwards of 40,000. Even the Faridabad Sector 20 is close to ARPOB of 40,000. In fact, Gurugram that we are starting in 12 months will be expected ARPOB to start off would be above of 50,000. And that is primarily due to 2-3 aspects. One is the change in our payer mix is concerned. So all the new hospitals are driven by the volumes in the self-payer as well as private insurance patients and international patients. So there's a very less contribution from the government pay mix, which is coming the new hospital, which is driving this higher ARPOB, as well as the change in the case mix. Today, we are, having good contribution from oncology, from transplant services, from high-end neurosurgeries. So as the case mix also improves, which is helping us to drive this high ARPOB, we feel going forward, somewhere around 10%, YOY growth for the full fiscal is expected for the ARPOB for good next 3-4 years are concerned.
You're looking at FY28 with an ARPOB of, on an average for all your hospital, would be around 40 to 42,000 rupees. Is
somewhere around that? Yes, somewhere around that. And the newer hospitals should be touching the ARPOB close to 50,000.
Wow. Okay, so that's very strong. What's the sense like, Yatharth, with regard to the receivable days? You said that you'll bring it down sharply. Now I see your receivable days are currently at 112. You're bringing it down to 1995, and you've done maybe a 10-day improvement over the last year or so. How so bullish?
See, this is something which will automatically change if we shift from a payer mix from more focusing on private insurance and self-payer and international patients and less government business. So as the newer hospitals that I talked about have hardly any share of government business, when their contribution, the overall pie chart increases, the debtor days are bound to come down. Not just that, over the last a year or so, we have deployed certain outsourced agencies to get our receivables faster. There have been better systems and places and process checks that have been placed. We are quite confident that in 2.5 years, we're targeting the receivable days should be around 70.
Right. So that's a substantial scale down. How much of your current business is government, and what's the proposed mix of government to overall revenue, say FY27, FY28?
The government mix in our new hospitals is not even 10%, and that's how we intend to be. For the existing hospital, because some are mature hospitals, have been running on a certain thought processes and certain areas that we have operated, especially if we talk about not just NCR but UP, in those hospitals like Agra, like Jhansi Orchha, that's where the government payer mix would be a bit higher. But our guidance for next 2.5 years, I think we want to be somewhere in the range of 25% as far as the overall government mix is concerned, because that will also ultimately help us to bring down those debtor days.
Right. Okay. Yatharth, great speaking with you. Thank you so much for coming in and speaking to us.
Thank you.
Well, viewers, it's been a packed show. First Trades, we've got a bunch of corporates who we've spoken to. We've tried to give you as many insights as we can. Of course, completely timed out on this edition of First Trades from Sajid, myself, everyone who puts this show together. Thanks so much for watching. Stay with us here on ET Now. More action to follow.